Welcome to the Luxembourg Fundcast. Today we're doing a real deep dive into Luxembourg securitization law and practice.
That's right.
We know your time is valuable, so we're drawing directly from the May 2025 Comprehensive Guide to pull out the absolute essentials.
Focusing on what really matters for legal pros, directors, COSAC.
Exactly. And key decision makers like you operating in the Luxembourg financial world.
It's about understanding the legal side, regulatory compliance, governance, the whole picture.
Think of this as your shortcut through the complexities. We'll make it clear.
Well, it's fascinating how Luxembourg built this position, isn't it? As a major European hub.
Absolutely. That flexible legal framework is key.
Yeah, the 2004 law plus all the amendments up to, May 1st, 2025, will unpack the core ideas, the features.
And the practical side. What does this actually mean for your day-to-day?
Exactly. The implications.
So our mission today, make the complex easy. We'll hit the key points, the responsibilities you need on your radar.
We'll cover the basics of securitization itself, the different types of vehicles.
Those SVs everyone talks about.
Right. Securitization vehicles and compartments, crucial concept.
Plus how they're financed, the rules on managing the assets. It's all in the guide, and we're filtering it for you.
Okay, let's dive in.
Let's start right at the beginning. Securitization fundamentals. What's the core idea? Why should you care?
Well, fundamentally, it's about taking assets, usually things like loans or receivables,
Okay.
pooling them together, and then issuing securities backed by those assets, making them tradable.
So turning something perhaps illiquid into something liquid.
Precisely. And that has big benefits. For the originators, banks, lenders,
What's in it for them?
several things. Generating liquidity, obviously. Transferring credit risk off their books.
Which helps with regulatory capital, right? Like Basel III.
Exactly. Basel III, solvency is the second for insurers. It frees up capital so they can lend more or invest elsewhere.
Makes sense. Access to capital markets too, I suppose.
Yes, and often a wider range of investors, potentially even lower funding costs than traditional borrowing.
And for investors, what's the appeal?
They get exposure to specific types of assets they might not otherwise access. Diversification for their portfolio.
And potentially better returns, adjusted for risk.
Potentially, yes. And they can often choose securities that match their specific risk appetite or maturity preference. You have different layers or tranches.
Tranching. So different levels of risk and return.
That's the idea. Senior tranches are safer, lower return. Junior tranches take the first hit if things go wrong, but offer higher potential returns.
It sounds like a pretty powerful financial tool, but it got some bad press back in 2008, didn't it?
Oh, absolutely. The financial crisis really shone a spotlight on the risks.
No one wrong there.
It was largely down to very complex securities, often backed by poorly underwritten U.S. subprime mortgages. Lack of transparency was a huge issue.
So people didn't really know what risk they were buying?
In many cases, no.
Yeah.
And that led to major regulatory reforms. Big focus now on transparency, disclosure, and making sure originators keep some skin in the game risk retention rules.
So the goal is to align incentives better.
Exactly. Fundamentally, securitization transforms and reallocates risk. It helps capital flow efficiently. But that complexity means you need robust rules and good due diligence.
Okay, that sets the scene. Let's turn to the Luxembourg framework itself. The guide calls it flexible. What makes the law of 22 March 2004, as amended, so adaptable?
Well, this law really is the foundation of Luxembourg's success. The amendments, particularly the big ones in February 2022, were about keeping it modern, flexible, and aligned with EU rules like the securitization regulation.
How does it define securitization? Is it narrow?
Actually, no, it's incredibly broad. Article 1.1 talks about an SV acquiring or assuming risks linked to receivables, other assets, or even third-party obligations.
So not just buying assets.
Not just true sales. It explicitly covers synthetic securitization, too, using things like guarantees or credit derivatives to transfer the risk without transferring the underlying asset itself,
Okay.
as long as the risks ultimately come from third parties. This breadth is a major source of its flexibility.
And there's this opt-in nature mentioned. What's that about?
That's another key differentiator. An entity doing securitization in Luxembourg only falls under this specific securitization law if it chooses to.
Chooses how?
By stating it in its Articles of Association, its constitutional documents, or maybe in the specific documents for an issuance.
So it's not automatic like the EU regulation?
Correct. The EU securitization regulation applies mandatorily if you meet its criteria. The Luxembourg law is elective.
What's the impact of that choice?
Massive versatility. Combine the broad definition with the opt-in nature, And Luxembourg SVs can be used for way more than just standard ABS or MBS deals.
Like what?
Bespoke structured finance, repackaging different kinds of instruments. They can even be part of complex acquisition structures because of the legal segregation features we'll get to.
And the 2022 changes push this further.
Definitely. Allowing 100% loan financing, permitting active management in some cases. It really amplified the toolbox available for structuring. Legal teams need to be aware of this wider range of possibilities now.
Right. Let's talk about those vehicles, the SVs. The guide mentions different legal forms. What are the main choices, and what should, say, a director consider when picking one?
Okay, fundamentally you have two main types. First, the securitization company. That's a proper legal entity like a corporation.
With its own legal personality.
Exactly. Second, you have the securitization fund. This is more of a contractual setup, like a pool of assets managed by a separate Luxembourg management company. It doesn't have its own legal personality.
Let's focus on the companies first. What kinds are available?
Luxembourg offers a lot of choice under the standard 1915 company law. Historically, the most common were the SA, Société Anonyme, like a public limited company, and the SARL, Société à Responsabilité Limitée, like a private limited company.
But the 2022 changes added more.
Yes, and strategically so. They added partnership forms, the CSSF en commandite simple and the CSSF en commandite spéciale. These are very popular in the alternative investment world.
Why add those? What's the benefit?
They offer tax transparency, generally speaking, and huge contractual flexibility. Much more freedom to define relationships between partners in the partnership agreement. Very useful for private debt or private equity type strategies using securitization. There are others too, SENC, SAS, quite a range.
And the securitization fund.
That's structured either like an FCP, a fonds commun de placement, a co-ownership structure, or as a fiduciary estate, a patrimoine fiduciaire. But critically, it always needs a Luxembourg commercial company to act as its management company.
So lots of choices. What are the key differences a director or co-sec needs to weigh up? Legal personality is one.
Right. Minimum capital is another. And SA needs EUR 30,000, but only 25% paid up initially. And SARL needs EUR 12,000, fully paid.
And the partnerships, SESSCSP.
No minimum capital requirement there, which is attractive.
What about shareholders or partners? Limits.
And SARL has a limit, 100 shareholders, and SA has no upper limit. Partnerships offer flexibility there too.
Governance must differ too, boards versus general partners.
Absolutely. The governance structures are quite different. And crucially, the default tax treatment varies. Companies are generally tax opaque, meaning the company itself is taxed.
Whereas funds and partnerships.
Generally, tax transparent. The income flows through and is taxed at the investor level.
Okay, so the choice of legal form has significant legal, governance, and tax implications.
Definitely. And adding SESSCSP wasn't just about adding choice. It allows much easier integration of SVs within existing alternative investment fund structures.
So?
You might use an SCS or SCSP SV as a feeder vehicle into a main fund, or for a co-investment setup, or even as a downstream holding vehicle. It simplifies things operationally and for tax planning. It really enhances Luxembourg's appeal as a one-stop shop.
Interesting. The guide also mentions two-tier structures.
Yes, the law explicitly allows setting up, say, one vehicle to acquire the assets and another linked vehicle to issue the securities, sometimes needed for functional separation or regulatory reasons. Lots of structuring options.
Let's move to compartments. You mentioned them earlier as key. The guide stresses this statutory segregation. Why is that such a big deal legally?
It's arguably one of the crown jewels of the Luxembourg system. A single SV company or fund can create multiple compartments. Each one is a legally distinct pool of assets and liabilities.
Legally distinct how?
It's segregated by law, statutory segregation. This means the assets belonging to one compartment are ring-fenced. They're only available to the investors and creditors of that specific compartment.
So creditors of compartment A can't touch assets in compartment B?
Absolutely not. Even if the main SV itself were to become insolvent, the segregation holds strong. This provides a much higher level of legal certainty than relying purely on contractual clauses, which you might see elsewhere.
That sounds incredibly valuable for risk management.
It is. Legally, each compartment functions almost like a separate entity when dealing with third parties, unless explicitly stated otherwise. Think of it as building secure, legally firewalled boxes within one overall structure.
And setting them up, is it complex, bureaucratic?
Surprisingly straightforward, usually. If the SV's articles allow it, the management body, The board of directors, for example, can typically create a new compartment by a simple resolution.
No need for notaries or specific regulatory approval for each one.
Generally, no. That makes it very practical and cost-effective. You can run many distinct securitization deals under one legal roof, avoiding the cost and hassle of setting up lots of separate SPVs.
I can see why that's popular.
Hugely popular. Many SVs have hundreds of compartments. The 2022 law changes also clarified things like approving accounts and financial reporting compartment by compartment, improving governance.
So this statutory segregation gives real confidence about bankruptcy remoteness.
Yes, it significantly reduces legal risk and structuring complexity. It's a major reason why Luxembourg is so attractive for multi-issuance platforms or deals involving very diverse asset pools, a real competitive advantage.
Okay, let's switch gears to financing these SVs. The guide highlights a major shift in 2022, moving beyond just securities. Tell us about that.
Historically, yes. The law talked mainly about SVs being financed by issuing securities valeurs mobilières. CSSF guidance even used to suggest borrowing should only be temporary or ancillary.
But 2022 changed that.
Fundamentally. First, they broadened the terminology from just securities to the wider legal term financial instruments financiers.
What does that include?
It references the definition in another key piece of Luxembourg legislation, the 2005 law on financial collateral arrangements. It covers debt, equity securities, warrants, other things meeting the definition. Gives more legal certainty.
But the bigger change was about borrowing.
Exactly. The law now explicitly states that SVs can finance themselves partly or even entirely through borrowing, taking out loans.
So 100% loan funded is possible now?
Yes. The old restrictions were removed. Borrowing is interpreted broadly, basically any debt with a repayment obligation.
What does this mean practically for structuring deals if you're advising a client?
It massively increases flexibility. It aligns Luxembourg with how things often work internationally. Some investors prefer loans or are restricted to them.
So it opens up the investor base.
It can do, yes, and ensures compatibility with the EU securitization regulation, which also accommodates loan financing.
Does it change the role of the SV itself?
You could say that. It's not just an issuance vehicle anymore. It can be purely a financing vehicle, funded entirely by loans from banks or other lenders.
What kind of structures does that enable?
Things like secured lending facilities, collateralized funding arrangements, maybe using an SV for intragroup financing. It's particularly relevant for private credit and structured lending deals.
Did the 2022 changes say anything about priority between different types of funding?
Yes, they clarified the default legal hierarchy, the subordination, unless you agree otherwise contractually.
What's the default?
Equity is subordinated to debt and loans, and fixed return debt instruments rank senior to variable return debt instruments. It sets a baseline for investor expectations on who gets paid back first.
So legal teams need to be really clear in the documentation if they want a different order.
Absolutely. The contracts rule, but the law provides the default.
Now, asset management. The guide mentions another evolution here, from passive towards allowing active management. What was the old approach?
Traditionally, Luxembourg SVs, often guided by CSSF practice, were expected to manage the underlying assets or risks pretty passively.
Meaning what? Just collecting payments?
Pretty much. Prudent administration, managing cash flows, dealing with defaults, making payments to investors. Active trading for profit wasn't really seen as part of the deal.
But 2022 changed this too, Article 61-1.
Yes, a significant shift. The law now explicitly permits active management, but under specific conditions.
What are the conditions?
Two main ones. First, the assets being actively managed must be debt-related. Risks linked to debt securities, financial debt instruments, or receivables.
So you can't actively manage a portfolio of, say, equities or fund units within this specific permission.
Correct. That remains outside this particular active management allowance for securitization vehicles.
And the second condition.
The SV, doing the active management, cannot finance itself through instruments offered to the public. It's restricted to privately placed deals.
Ah, so active management is okay, but only behind closed doors, effectively, not for retail investors.
That's the gist of it. It seems clearly designed to make Luxembourg more attractive for structures like CLOs, collateralized loan obligations, or CDOs.
Which inherently involve active management of loan or bond portfolios.
Exactly. This change addressed a previous gray area and makes Luxembourg more competitive for that type of institutional business.
Does the SV need to declare this upfront?
Yes. If an SV plans to actively manage assets under this provision, It needs to state that in its constitutional documents.
So it creates a sort of two-track system, flexibility for private deals, caution for public ones.
That seemed to be the balance they struck. It implicitly confirms Luxembourg's broad interpretation of what securitization can cover, while adding safeguards for public offerings. Compliance frameworks need to reflect this distinction.
Okay, the guide lists several key advantages of the Luxembourg regime. From the perspective of legal counsel, directors, COSECs, which ones really stand out as impacting their work?
Well, the bankruptcy remoteness via compartments is huge. That statutory ring fencing gives immense legal certainty. It's often seen as much stronger than just relying on contracts.
Peace of mind for originators and investors.
Definitely. Then there's the incredibly broad asset eligibility. You can securitize almost anything with a measurable value or predictable cash flow. Traditional loans, yes, but also trade receivables, lease payments, fund interests, intellectual property royalties, even tangible assets potentially with caveats.
That opens up a lot of innovation.
It does. It distinguishes Luxembourg from regimes with narrower definitions. Then there's the corporate flexibility we discussed, choice of legal forms, compartments, the financing options now, including loans, conditional active management.
High degree of customization possible.
Very high. Valuable for complex, cross-border deals. And finally, the investor protection mechanisms are solid. Compartment segregation, limited recourse clauses, default subordination rules, mandatory audits for all SVs, plus CSSF supervision for public offerings.
So a balance between flexibility and safeguards.
That's the aim. Legal and governance professionals need to understand how to leverage these advantages while ensuring compliance with the protective measures.
Let's talk regulation and governance more directly. The guide covers the environment as of May 1st, 2025. CSSF supervision, who needs it, who doesn't.
This is a crucial point. Most Luxembourg SVs are not directly supervised by the CSSF.
Really? Most are unregulated.
From a prudential supervision perspective, yes. CSSF authorization and ongoing supervision only kick in if the SV issues financial instruments to the public on a continuous basis.
And the 2022 law clarified what that means.
Yes, it codified the triggers. Continuous basis generally means more than 3 public offerings in a financial year, looking across all compartments.
Okay, and to the public.
That requires meeting all 3 of these conditions. 1, the offer is not exclusively aimed at professional clients as defined under MiFID SECS. 2, the denomination of the instruments is less than EUR 100,000. And 3, it's not considered a private placement under prospectus rules.
So if you fail any one of those tests, it's not deemed to the public for CSSF supervision purposes.
Correct. It's quite a high threshold to trigger mandatory supervision.
What's the implication of that high threshold?
It allows a very large private institutional market to operate efficiently with minimal direct regulatory burden from the CSSF. But it also ensures that structures genuinely targeting the broader public are overseen.
What's the process if an SV does need authorization?
The CSSF reviews the constitutional documents, the management structure, organization, financials. They assess the people involved. There's usually a meeting. Authorized SVs also have specific requirements, like appointing a Luxembourg bank as custodian for liquid assets.
And the CSSF can enforce this?
Yes, the 2022 law gave the CSSF powers to sanction SVs that meet the criteria but haven't sought authorization.
Beyond direct supervision, the guide points to lots of other regulatory updates. What should be on the radar for compliance?
There's been a real wave of regulatory activity, much driven by the EU. CSSF circulars on outsourcing are important, now aligning with EBA guidelines and incorporating DORA requirements.
DORA, the Digital Operational Resilience Act, that's significant.
Huge. Affects ICT risk management, incident reporting, third-party provider management. It applies from January 2025, so compliance is a major focus.
Real.
Updates related to SDS securitizations, lots on AML-CFT incorporating EBA guidelines on risk factors, and the travel rule for crypto transfers. Sustainable finance is big, SFDR, taxonomy, CSRD. The CSSF is actively supervising this, issued guidance on ESG fund names, and even issued its first SFDR-related sanction in late 2024.
Wow, so ESG isn't just optional anymore.
Not if you fall into the scope. MICA, the Markets in Crypto Assets Regulation, is fully applicable from late 2024, though generally excludes security tokens, which might be relevant for some SVs. Plus updates linked to the prospectus regulation, money market fund stress testing.
It sounds like a lot of indirect pressure, even for unregulated SVs.
Absolutely, especially through the requirements placed on their service providers, administrators, custodians, auditors. Directors and COSECs need robust oversight of those providers.
What about the CSSF FAQs? Were they important? Are they still?
Historically, very important, they provided practical interpretations, especially on things like borrowing limits or passive management, before the 2022 law codified them.
So less critical now, the law is clearer.
The law provides more certainty now on those points, but FAQs might still offer insights on areas where the law is silent or needs interpretation. The key is always to check against the current law and recent CSSF communications first.
Okay, let's talk governance framework. What are the key duties for directors, comparing regulated versus unregulated SVs?
For all securitization companies, the basic duties under the 1915 company law apply: duty of care, loyalty, acting in the company's best interest.
Standard director duties.
Yes. But for regulated SVs, the CSSF imposes extra layers. You generally need at least 3 directors. They must be of good repute, have relevant professional experience.
Higher standards.
Yes. They need to demonstrate awareness of the SV's financial situation, understand their responsibilities to investors and the CSSF. There are rules about using corporate directors, too.
And organizational requirements.
Regulated SVs need an adequate administrative and accounting setup in Luxembourg. And there's a growing expectation around risk management, especially ICT and cyber risk, aligning with general CSSF standards for supervised firms. Internal controls are also scrutinized.
What about unregulated SVs? Lighter touch.
Formally, yes, the requirements stem mainly from company law. But robust governance is still vital. Directors have fiduciary duties. They need to oversee service providers effectively, ensure AML-CFT compliance. The bar is effectively raised indirectly by the regulations hitting those service providers.
And the mandatory audit?
That applies across the board. All SVs, company or fund, regulated or unregulated, must have their annual accounts audited by an approved Luxembourg statutory auditor, a réviseur d'entreprise agréé.
Any other reporting?
Yes, regardless of CSSF status, SVs generally have statistical reporting duties to the Luxembourg Central Bank, the BCL. Initial registration, then periodic data, balance sheets, transactions. It's for monitoring financial vehicle corporations across Europe.
Okay, let's shift to practical legal and tax points. True sale versus synthetic securitization. What are the key legal considerations?
The fundamental difference is ownership. In a true sale, the originator legally sells and transfers the assets to the SV. Ideally, they come off the originator's balance sheet.
And synthetic?
The originator keeps the assets on their balance sheet but transfers the credit risk associated with those assets to the SV, usually using credit derivatives like credit default swaps or sometimes guarantees. The SV holds collateral against this risk exposure.
Why choose one over the other?
Depends on the goals. Off-balance sheet treatment often drives true sales. Hedging risk without selling the asset might favor synthetic. Sometimes asset transfer is legally tricky or contractually restricted. Efficiency, investor preference, various factors.
From a Luxembourg legal perspective.
For true sale, the focus is ensuring the sale is effective under Luxembourg law. The assignment is legally binding upon agreement, and the SV's ownership would stand up even if the originator went bankrupt. Perfection against the underlying debtors, however, is usually governed by the law applicable to the receivable itself, often determined by Rome on regulation.
And for synthetic?
The legal focus shifts to the enforceability of the derivative contract or the guarantee agreement. Tax treatment generally follows the legal form.
And Luxembourg accommodates both easily.
Yes, the framework is agnostic. Synthetic is a valuable option, especially for banks managing regulatory capital or portfolio concentrations without actually selling the underlying loans.
What about offering structures, public versus private placements? We touched on this for CSSF supervision.
Right. That's a key driver. Avoiding the continuous public offering triggers generally means using private placements, which bypasses direct CSSF supervision.
Are there prospectus implications too?
Yes. If you're making a public offer within the European Economic Area, you generally need a prospectus approved by the CSSF under the EU prospectus regulation and Luxembourg law.
But there are exemptions.
Plenty. Offering only to qualified investors, offering to fewer than 150 non-qualified persons per member state, minimum investment of EUR 100,000, or if the securities have a denomination of at least EUR 100,000.
And if you fall under an exemption, it's a private placement.
Generally, yes. You typically use a private placement memorandum, PPM, or similar offering document instead of a full prospectus.
And active management is only allowed for
privately placed transactions. Another incentive to avoid public offers if you need that flexibility.
So the vast majority of Luxembourg deals are private placements.
Overwhelmingly so. It avoids the regulatory burden and costs, targets sophisticated institutional investors, and allows for more flexibility, including active management. It really supports the wholesale market.
Let's talk tax. The goal is usually tax neutrality for the SV, right? How is that achieved?
That's the main objective, yes. Treating the SV largely as a pass-through, how it works depends heavily on the SV's legal form.
Okay, for securitization companies, SA, SARL.
These are generally fully subject to Luxembourg corporate income tax and municipal business tax. The combined rate is around 24.94% in Luxembourg City currently.
That doesn't sound neutral. How do they achieve neutrality?
Through deductions. The key is that commitments the SV makes to its investors and creditors paying interest on notes, dividends on shares, are fully tax-deductible expenses for the SV company.
Ah, so the income from the assets flows in, but the payments out to investors are deducted.
Exactly. This typically reduces the taxable profit down to zero, or something negligible. They might also benefit from double tax treaties or EU directives subject to subsist requirements.
What about securitization funds, FCP style?
They are treated as tax transparent for corporate income tax, municipal business tax, and net wealth tax. The income is taxed directly at the investor level based on their own status.
But they don't get treaty benefits.
Correct. No access to double tax treaties or EU parent subsidiary interest royalty directives.
And the partnerships, SCS, SCSP.
Also generally tax transparent for corporate income tax and net wealth tax, provided they don't conduct commercial activities and any general partner holds less than 5%. They also don't typically get treaty access themselves.
Is there a risk with partnerships? Hybrid rules?
Potentially, yes. The reverse hybrid rule, Article 168 Quater LIR, could apply. If non-resident investors who view the partnership as opaque in their own country hold 50% or more, and the income isn't otherwise taxed.
Then the Luxembourg partnership itself becomes taxable.
On that portion of its income, yes. There are exemptions, for example, for certain regulated collective investment vehicles, but applicability to SEs needs case-by-case analysis. It requires a specific tax return, too.
Okay. Other key tax points. Withholding tax.
Generally, no withholding tax on interest or dividends paid by Luxembourg SVs. There's a potential exception for certain interest paid to Luxembourg resident individuals, but broadly, it's zero. Corporate SVs can use tax treaties to reduce withholding tax on incoming income from the assets. Transparent SVs can't.
Net wealth tax.
Corporate SVs pay a minimum NWT, currently EUR 4,815. Funds and transparent partnerships are generally exempt.
VAT subscription tax.
Management services provided to SVs are generally VAT exempt. And SVs are generally not subject to the annual subscription tax that applies to regulated investment funds.
How will duty?
Just a nominal fixed duty of UR 75 on incorporation or capital increases. Regulated SVs do pay annual supervision fees to the CSSF, though.
So neutrality for corporate SVs relies heavily on the deductibility of payments to investors. Is that vulnerable?
ATAD.
That's the key sensitivity. The EU Anti-Tax Avoidance Directive, ATAD, introduced rules that could potentially affect this. The main one is the Interest Limitation Rule, Article 168 EBIS LIR.
How does that work? It generally limits the deductibility of net borrowing costs to 30% of the taxpayer's EBITDA, earnings before interest, taxes, depreciation, and amortization. There was uncertainty about how this applied to SVs.
Are SV payments considered borrowing costs, even dividends?
That's debated. But there are mitigating factors and exemptions. Standalone entities might be exempt, though the definition is complex. Financial undertakings might be exempt, but SVs don't always neatly fit the definition. There's grandfathering for older loans. And a strong argument exists that SV interest payments are directly linked to the income generated by the securitized assets, not excess borrowing costs the rule targets.
So market practice generally assumes neutrality is preserved.
Generally, yes. Most standard structures are considered outside the scope or able to benefit from exemptions, but it added complexity and requires careful analysis. The CSSF issued guidance in Circular LIR N-degrees 168 BS1.
What about other ATAD rules? Hybrid mismatches.
Yes, Article 168 or LIR tackles hybrid mismatches arising from different tax treatments between jurisdictions, relevant for complex cross-border setups.
And the reverse hybrid rule we mentioned for partnerships.
That's Article 168 Quarter LIR. Definitely relevant if you're using SCS or SESP structures with non-resident investors from certain jurisdictions.
Transfer pricing is relevant too?
Yes, the arm's length principle applies to related party transactions. Circulars LIR 561 and 56 bis 1 on intergroup financing are important if the SV is part of a group structure, emphasizing substance and arm's length remuneration.
So ATED shows Luxembourg isn't isolated from international tax changes. Neutrality needs careful navigation.
Precisely. It adds layers of complexity to maintain that tax-neutral outcome.
And double tax treaty access. Who gets it?
Generally, only Luxembourg tax residents subject to tax, so the securitization companies,
Mhm.
SA, SARL, etc. Tax-transparent entities like funds and partnerships usually can't claim treaty benefits themselves, although their investors might be able to based on their own residence.
Why is treaty access important?
To reduce or eliminate withholding taxes imposed by other countries on the income flowing from the underlying assets held by the SV.
Are there hurdles to claiming treaty benefits?
Yes, you need to meet the treaty definition of resident, be the beneficial owner of the income, navigate anti-abuse rules like the Principal Purpose Test, PPT, introduced by BEPS.
And substance, is that important?
Increasingly critical, you need to demonstrate genuine economic activity and decision-making in Luxembourg. Having qualified staff, real offices, it matters. Just being a brass plate isn't enough anymore.
So there's a trade-off. Corporate SVs get potential treaty access but face domestic tax rules and ATED complexity.
While transparent SVs avoid the domestic tax complexities, but generally sacrifice direct treaty access. The best structure depends on where the underlying income comes from, its nature, and the tax profile of the investors. Substance is key for either route if treaties are involved.
Okay, let's look at the market. How big is Luxembourg in the securitization world?
It's a dominant center in Europe. Estimates vary, but we're talking maybe around 1,500 active SVs, potentially housing thousands, maybe 6,000 to 8,000 individual compartments or transactions by early 2024. And it continues to grow.
What kind of assets are typically securitized through Luxembourg?
A very wide range, thanks to that flexible law. Loans are big commercial loans, mortgages, RMBS, CMBS, auto loans, consumer loans. Repackaging debt securities or bonds is common. Trade receivables and supply chain finance structures.
What else?
Interest and investment funds get repackaged. Real estate assets beyond mortgages. Lease receivables. Non-performing loans, NPLs, although maybe more in private markets recently. Structured products. CLOs, an area Luxembourg hopes to grow further after the 2022 law changes. Even things like intellectual property royalties.
So really diverse. Are there common structures we see often?
Multi-compartment vehicles are almost universal. Private placements are the vast majority. True sale structures are very common for achieving off-balance sheet treatment.
And newer trends.
Loan financing is definitely increasing post-2022. Partnership forms like SCS, SCSP are gaining traction, especially linked to alternative funds. Repackaging remains a staple. Orphan structures, where the SV shares are held by a foundation or trust for ultimate bankruptcy remoteness, are also used. And we see SVs used within fund structures for holding assets or providing leverage.
Who are the main players? Investors? Service providers?
Investors are typically institutional. Banks, insurance companies, pension funds, investment funds, family offices, private equity houses. Service providers are crucial corporate service providers, law firms, auditors, banks acting as custodians or paying agents, arrangers who structure the deals.
What about recent market trends, say 2024, 2025? What's the vibe?
The broader European rated securitization market saw moderate growth. U.S. ABS market was quite strong. MPL securitization in public markets was a bit subdued. More activity in private deals and secondary trading. Concerns about commercial real estate and SME NPLs persist. U.S. CLO market hit records. European CLO activity was present. And as mentioned, Luxembourg is positioning itself to capture more of that. Private debt generally has seen strong growth in Luxembourg. And importantly, the number of Luxembourg SVs keeps ticking up, utilizing those new features from the 2022 law.
Looking ahead, what are the big challenges or future trends?
The EU regulatory landscape is a major factor. ESG integration, SFDR, taxonomy, CSRD means more transparency demands, data challenges, greenwashing risks for relevant structures. The ongoing review of the EU securitization regulation could bring changes affecting scope, STS criteria, reporting. That will impact Luxembourg.
Technology.
Definitely. Fintech innovation, distributed ledger technology or blockchain for issuance, servicing, maybe even tokenization of securities. Luxembourg has been proactive in creating legal frameworks for DLT. AI and data analytics are impacting risk assessment and portfolio management too.
Market demands. The economy.
Investor appetite continues to evolve. Search for yield, diversification, growing interest in ESG. Originators still need tools for capital management and funding. The shift towards private markets is significant. And of course, the overall macroeconomic climate, interest rates, growth prospects, always plays a role.
Any potential domestic changes to watch?
Always need to monitor potential tax reforms, maybe linked to BEPS Pillar 2. any modernizations to company or fund law, refinements to the DLT framework, keeping an eye on government announcements, CSSF publications, tax authority updates, and industry association papers is key, and EU developments, naturally. So if we connect all this back to the bigger picture for everyone listening to the Luxembourg Fundcast, it's clear Luxembourg offers a really sophisticated, adaptable platform for securitization.
But it needs careful handling.
Absolutely. The framework is flexible, but navigating it requires real expertise, especially with those increasing layers of EU regulation and the sometimes complex tax rules we discussed. The guide is invaluable here.
So, wrapping up, what does this all mean for you? As legal professionals, directors, company secretaries, key decision makers?
Well, understanding these details isn't just nice to have. It's pretty essential, wouldn't you say?
I'd agree. Whether you're setting up new SVs, managing the ones you already have, or just considering Luxembourg as an option.
You absolutely need a solid grasp of the legal forms, how compartments work strategically, the financing options, especially the newer ones.
What triggers regulatory oversight, the tax angles? It's all crucial for making good decisions, staying compliant, and ultimately for success.
Which brings us to a final thought, perhaps. A question for you to mull over after this deep dive.
Go on.
How can the strategic use of those highly flexible compartments, combined with the updated financing possibilities, like using loans under the current Luxembourg Securitisation law,
Yeah. How could that create genuinely new opportunities or maybe just better efficiencies for your specific organization or for your clients? That's a great question to leave our listeners with. How can you leverage this framework better?
something to think about.
Thank you for joining us for this deep dive into Luxembourg securitization law and practice, drawing from that comprehensive May 2025 guide here on the Luxembourg Fundcast. We really hope this has provided valuable, practical insights.
We definitely encourage you to explore the specific details further the law itself, the CSSF circulars. Use resources like the guide.
Absolutely.
And remember, knowledge is one thing, applying it is another. Hopefully this discussion provides a solid foundation for that application within Luxembourg's really dynamic financial landscape.
Well said. Thanks again for listening to the Luxembourg Fundcast.